Today, I want to dive into a topic that's been sparking a lot of debate lately: the future of cash ISAs. With growing speculation about potential changes by the Chancellor, Rachel Reeves, the debate is heating up over the best strategies for holding cash while minimizing tax. This has raised concerns about how such a change could affect the use of cash ISAs for managing emergency funds and cash reserves. If you find topics like this helpful, take a moment to like and subscribe. Your support is truly appreciated. There's been quite a bit of discussion recently, along with some concerns, about what the Chancellor might do with cash ISAs. The main worry is that she may reduce the annual allowance to £4,000 to encourage more people to invest in UK companies. While I understand the reasoning behind this, I have some reservations. The idea is that investing in a stocks and shares ISA could provide significantly better long-term growth than keeping money in a cash ISA earning interest. And on that point, I absolutely agree. However, I disagree with the principle of restricting people's choices to achieve this goal. Forcing people down a particular route feels a bit like we're not trusted to make our own decisions. This leads to my second point. You don't want to have all your money in stocks, regardless of returns. What if you're building an emergency fund for unexpected expenses, or cash reserves in retirement? Having cash reserves can be crucial to covering living costs during market downturns, allowing investments time to recover without selling at a loss. You'd likely want to keep that money safe and easily accessible, and a cash ISA is a great way to do that while also protecting interest earned from tax. And then there's the issue of home bias. Why limit ourselves to UK stocks when we can access a global portfolio of equities? I'm a strong advocate for global diversification, so a UK-centric approach just doesn't add up. But before you get too anxious, I want to stress that the Chancellor hasn't made any final decisions. I strongly recommend that you do not make any sudden changes to your savings or investments based on mere speculation, no matter how convincing it may sound. Just look back at the buzz during the Chancellor's autumn budget in October 2024, when some people panicked and withdrew their full 25% tax-free lump sum from their defined contribution pensions, only to regret it later when no changes were announced. Many were even blocked from returning that money to their pensions, despite most providers offering a cooling-off period. The key takeaway here is, never make financial decisions based on rumors or speculation. So, today's discussion isn't about whether the cash ISA allowance might be reduced or not. Instead, I want to think about how we can effectively manage our cash reserves, regardless of what happens with cash ISAs. Let's take a quick look at how people in the UK have been using their ISAs. The latest government report, published in September 2024 and updated in December, indicated that there were approximately 7.9 million cash ISAs, making up 63% of the total, while around 3.8 million were stocks and shares ISAs, representing 31%. This data indicates that UK savers have a strong preference for cash ISAs over stocks and shares ISAs, with cash ISA accounts more than double those of stocks and shares ISAs. Despite the popularity of cash ISAs in terms of account numbers and subscriptions, the total value of all the money held in stocks and shares ISAs is significantly higher than the total value in cash ISAs. In fact, it's almost 45% higher. Now, this isn't really surprising. Over the medium to long term, investing in the stock market generally gives you a much better chance of achieving higher returns than the interest rates you get on cash savings accounts. A recent survey by AJ Bell asked their customers what they would do if faced with a lower cash ISA allowance. Half said they would use a non-ISA cash savings account, just over a third would invest in stocks, and interestingly, about a fifth would either spend the cash or reallocate it to buy cryptocurrencies. Noticeably missing from these responses was the option of holding money in a money market fund within a stocks and shares ISA, and that's a gap I want to address today. Money market funds can play a really useful role for people who need to have reliable access to cash for short-term needs, such as an emergency fund when you're working, or as part of your cash reserves when you're in retirement. So, let's consider two scenarios, one for an emergency fund in your working years and one for cash reserves in retirement, and compare what life might look like without cash ISAs. Before I go any further, let me be perfectly clear. I'm not suggesting that Rachel Reeves is considering abolishing cash ISAs. However, if you don't currently have one, or if you haven't yet reached your target savings for your emergency fund or cash reserves, here's what I would personally do instead. I would simply disregard cash ISAs altogether, regardless of any decisions the Chancellor may or may not make.
Am I bothered?
Excuse me?
Am I bothered? What do you think I'm bothered? I don't care, mate. I ain't bothered.
I know this might sound extreme, but let me explain. For my emergency fund and cash reserves, I would prefer to use a standard bank savings account. Yes, This approach might incur tax if you earn more than £1,000 in interest, if you're a basic rate taxpayer, but I'd then allocate my full ISA allowance exclusively to a stocks and shares ISA. Now, you might wonder, how does a stocks and shares ISA factor into holding cash reserves? Well, within a stocks and shares ISA, you have the flexibility to hold money market funds. These funds invest in a mix of cash deposits, certificates of deposit, short-dated government bonds, and near-cash equivalents, all regulated under UK money market fund regulations. Many financial experts consider money market funds to be low to very low risk. Let's take a look at the track record and historical failures of money market funds, while keeping in mind that past performance is never a guarantee of future results. In the US, there have only been 2 failures in total. The first was the Community Bankers US Government Fund in 1994. And the most recent was the Reserve Primary Fund in September 2008, right in the middle of the global financial crisis. Now, in the UK, it's interesting to note that there have actually been no recorded failures of money market funds. This is largely thought to be due to broader interventions by the Bank of England to maintain stability in the financial markets. Since the global financial crisis, both the US and the UK have been progressively introducing stricter regulations for money market funds, as well as more robust stress testing to make sure they can withstand difficult market conditions. In fact, we're expecting new recommendations for UK regulations to be released in the first quarter of 2025. These are likely to include even higher requirements for the amount of liquid assets that these funds must hold on a daily and weekly basis. Now, it's important to remember that the Financial Services Compensation Scheme, or FSCS, does provide protection for investments up to £85,000 per person, per authorised firm. This means if the platform or fund provider fails, you could be covered up to this limit, though this may not be sufficient if your total investment exceeds that amount. Crucially, FSCS does not cover losses due to poor investment performance. So, to summarize what I would personally do. Firstly, I would ignore cash ISAs for my emergency fund and cash reserves. Secondly, I would hold up to the maximum amount in a regular bank savings account so that I don't incur any tax on the interest. The exact amount will depend on the interest rate and your tax bracket, but we'll look at an example in a moment. Thirdly, I would keep the rest of my cash reserves in a money market fund within a stocks and shares ISA. And finally, I would invest any remaining money I have in broadly diversified equity and bond index funds, within tax-advantaged accounts such as in SIP, workplace pension, and stocks and shares ISA. But how practical is this for those who are still working and for those who are already retired? Let's consider an example. The maximum balance you can hold in a conventional savings account without incurring tax depends on your interest rate and your personal savings allowance. For a basic rate taxpayer, you would be able to hold just over £22,000 at an interest rate of 4.5%, a rate which is achievable as we head into March 2025. As the interest rate drops, the maximum tax-free balance increases since the personal savings allowance remains fixed. Now, how do you know if this meets your needs for an emergency fund or a cash reserve? For the accumulation phase, we can look at data from the Office for National Statistics. According to their 2023 data, the average household expenses come to around £29,500 in 2023. If we adjust that for inflation at 2.8%, we get to about £30,300 for 2024. If you follow the common rule of thumb to keep 6 months' expenses in an emergency fund, the available personal savings allowance is more than ample, even in a worst-case scenario with interest rates of 4.5%. For a single person, this covers roughly 73% of annual average expenses, and for a couple, about 98%, which comfortably exceeds the typical 6-month emergency fund recommendation. Now, let's think about retirement. When it comes to the decumulation phase, we can refer to the Retirement Living Standards Recommendations for a Moderate Lifestyle, published in 2024. For a single person, this figure is approximately £31,300, and for a couple, around £43,100. In retirement, it's generally advised to keep between 2 to 3 years' worth of expenses in cash. At an interest rate of 4.5%, the savings balance we talked about earlier might fall a bit short of this, especially for a couple needing 2 to 3 years of reserves. But here's the thing to keep in mind. You should ideally be thinking about reallocating your investment portfolio in the 5 to 10 years leading up to your retirement. This often involves gradually reducing your exposure to potentially riskier assets like stocks, and increasing your allocation to more stable assets like cash and bonds. This helps to protect you against sequence of returns risk, which is the risk of experiencing poor investment returns right at the beginning of your retirement. For instance, during the global financial crisis, stock markets plunged by as much as 60%, which is why having some dry powder in cash is so important. So, you've actually got a fair bit of time leading up to your retirement to build up the remaining 1 or 2 years of cash reserves using money market funds in your stocks and shares ISA. So, this isn't really a major problem. However, there is a cautionary note for those with very low risk tolerance. Over-allocating to cash and bonds in retirement can introduce portfolio longevity risk, because you need some exposure to equities to generate returns that keep pace with inflation. One interesting solution is the dynamic portfolio allocation technique called the rising equity glide path, introduced by Michael Kitces in 2013. This strategy starts with a very small equity allocation at retirement and gradually increases it over time. In the capital market models examined by Kitces and Wade Pfau, the rising equity glide path performed best under historical data. When future returns are expected to be lower, a static allocation of 60% or more in equities might seem preferable, though it typically has only about a 1% lower probability of success compared to the rising equity glide path. If you'd like me to delve deeper into the rising equity glide path in a future video, please let me know in the comments. Before I wrap up, let's briefly review some of the popular money market funds available today. Among the ones I keep an eye on are the Royal London Short-Term Money Market Fund, the Legal and General Cash Trust, and the Fidelity Cash Fund. These funds generally have a solid track record and are considered low to very low risk. These are just a few examples, and it's always a good idea to do your own research to find funds that suit your individual needs and risk tolerance. So, what impact would the rumored changes to the cash ISA allowance have on how I'd manage emergency funds or cash reserves? Nothing. Absolutely nothing. If you found this video helpful and want to learn more about strategies to ensure your money lasts in retirement, I'd recommend watching this video here. Don't forget to like, share, and subscribe for more content. Thank you for your support and I'll see you in the next one.